Good afternoon, everyone. My name is Jeffrey Scott, and this webinar is brought to you by the North San Diego County Realtors. So we want to thank them for the opportunity to bring you a class on mortgages and to bring you up to speed on how to help manage your customers' expectations through the loan process. My name is, again, Jeffrey Scott. I've been a loan officer for 18 years. It's very simple for me to do loans. I promise I will make it very simple for you to do loans. Normally I manage this class or teach this class in a live setting. So we're going to try to get back to that when we can. And the reason is because it gives you the opportunity to ask questions along the way and learn the things that are important to you while have this hour together. In this particular case, we don't have a chat box, which handicaps me a little from communicating, which is not a problem. So I want you to please jot down my information. That's my personal cell phone number, and then my email address. And if you would email me your questions, or you can call afterwards. Or even if you wanted to text during the session, I've got my cell right here. I'll try to monitor it. So with that said, we have an hour, and my goal is, this is part one of two parts. And my goal is to help the realtor understand not only the loan process, but the right questions to be asking during the loan process. So you're fully educated as to where the loan is at in any of its given milestones. And at the same time, you're able to help manage the customer's expectation ahead of time on what's going to transpire. So I start this off with kind of a fun question. How many people do you think it requires to Oh, I think we have a chat. Maybe we got chat up and running. Okay, so my sound went down. It's hard to hear you. Okay. Let me check the volume. Maximize the volume. And is that any better on my sound? I see the chat. Much better. Okay, great. I maxed the volume out. Okay, great. So if things change, I do see the chat, and thank you, Shirley, if that's you, for helping me out. We want to keep, we want them to hear. Okay, great. So where I was at was the question, the $1 million question is, how many people do you think does it take to close a loan or required to close a loan? And I get a lot of people that say, oh, it probably takes 10 people. And some people say it takes 15 people. And if you guessed around 19 people, that's probably the more accurate number of people that it takes to close a loan. I'll walk it through. I'll walk it through real quick. There's a loan officer that originates the loan. There's a loan officer assistant. There's a processor, there's a junior processor, there's an underwriter, there's an escrow officer, an escrow assistant, a title officer. There's an appraisal management company that actually hires the appraisal. So those are two different groups. And then in-house, there's a lender's appraisal review department, which you're probably unfamiliar with, but we actually review the appraisals for accuracy because we find a lot of mistakes. So that's got to get blessed. There's a homeowner's fire insurance agent that's involved. And if it's a condominium, there's going to be an HOA manager that's going to complete the HOA condo questionnaire. And then there's also going to be a condo project review department that's going to review what the condo manager said on the HOA project questionnaire. So condos convoluted a little. Then you have a doc draw specialist. Those are the loan documents. And then you have a notary that gets assigned. And then once the docs are signed and back, you have a funder that funds the loan, the wire is requested from a wire department. And then once all the dust settles, you have somebody at the county recorder's office recording it. So you can count anywhere from 17, 18, 19 people to knock that out. So with that said, real quickly, I've jumped ahead to loan documentation. And what that means is that the loan officer is going to start the loan application online with your customer. Your customer originates the application online. We send them a link. The link is to a customer questionnaire. They fill out the link. As soon as it's completed, it comes back to my desk and we can start to analyze the file. The reason it's done that way today, and we don't take handwritten, I can still take a handwritten 1003, which is now called a URLA, but doesn't matter what it's called. I can still take the application on the phone over handwritten, but where it gets sticky is that we still need the customer to go online to accept electronic documents, because that's the way the process is run today. So when the customer does do his online application, then they're agreeing to accept electronic documents, which is a requirement. And therefore, if they do, I can complete the rest of the application, backfill all the information, not a problem. But my point is customers have to be at least computer savvy enough to get online, go to the link, get the application filled out, the customer questionnaire. Okay, so with that said, the documentation that we're going to need to collect from any consumer at any given time really is weighed on whether or not it's a purchase or a refinance. But since you're realtors, we're going to talk mainly about the purchase, because that's what's important to you. And then we're going to talk about some miscellaneous documents that are going to need to be backfilled and why. So there's three groups of documentations. There's the property, there's income, and there's assets. So just keep that in the back of your mind, three groups of documents. The property documents are going to include the RPA, the residential purchase agreement, all the addendums, and all the counteroffers. Please take note that we can't use a half-signed document. So I do have a handful of realtors that will present an offer on a property. Their customer will sign it, the buyer, and then they'll send us everything thinking they have a deal, when in fact it convolutes it, because we can't use any of those documents. We have to have a fully executed contract, and we need to have a quote from a fire insurance agent, which we can help manage after the RPA is accepted. And then if there is an HOA involved, we need the name and the contact of that person. And that's all we need for a purchase, okay? So it's pretty simple on the property side. Then on the income side, there's going to be two paths that are going to be taken. If the customer is a W-2 employee, right? He works for a company, then all we're going to need are 30 days of pay stubs and 2 years of W-2s. That's path one. And that's the simple path. And that's the easy path. And 9 out of 10 times there's nothing that's going to trigger the need for tax returns. Path number two is if the customer is self-employed. And if the customer is self-employed, then we're going to need to understand how his income is generated. Therefore, we're going to be asking for 2 years of 1099s or tax return K1s, or we're going to be asking for we'll definitely be asking for their 2 years of 1040 personal tax returns. And if they're incorporated or have an LLC, we're going to be asking for 2 years of business tax returns. So you have your 1120s, which are corporate, and your 1165s, which are partnerships. So the guy or the lady might have a partner, a 50-50 partner. So that's why it's called 1165s, because it's a partnership. But anyway, that's your income documentation. Two paths, super easy. Most of the time, well, not always, I'd say 70% of the time we're dealing with W-2, super easy. 30% of the time we're dealing with self-employed, super easy at the end of the day. Harder to qualify, but still super easy to do. And then the last category is assets. And just think of bank statements. So the best way to do it is for the customer to submit bank statements 60 days if they're liquid funds like checking, savings, or money market, and then 90 days if it's a retirement account. So for your SEPs, your IRAs, your Roth IRAs, your pensions, anything that's retirement related is going to require 90 days. Cool. So that's your documentation. Super easy to get. We shoot the email out to the customer. Customers hate doing this, but actually it's super easy, right? It's not hard to get PDFs off the internet to send these documents or scan them, but it does take some patience. And we manage the customers along the way as though it is easy, because it really is easy. Now, there's going to be some miscellaneous documents that I'm going to want you to take note of, because I want you to be asking your customers, because these are hiccups that cause loan delays and cause problems. So getting an ID is not a problem. Getting the earnest money deposit is not a problem. The terms of withdrawal is an issue a lot of times. If the customer is using 401k money, the terms of withdrawal state how the customer can withdraw that money. So they might think they can withdraw 100% of it, when the reality is you can only withdraw 50% of 401ks up to $50,000 unless the plan states otherwise. So that right there is a trap door. A divorce, ask them if they've been divorced before, because that's a trap door. A lot of times we get customers that don't tell you they're divorced or in the middle of a divorce. And that just completely convolutes things. And the reason why is because there's child support and there's alimony attached to a divorce. So think of that as debt, which changes your debt to income ratio. So those are trap doors. The Social Security letter, if you're drawing Social Security income, is super easy to get, but nobody can find it. Just give them a heads up, start looking for it. Trust documents, we can do loans in a trust. It's not a problem. It has to be an a revocable trust, cannot be an irrevocable trust. And we would need the full trust agreement to send to the attorney, or a trust cert, which is a summary of the full trust. Bankruptcies, ask your customer, another trap door. Have you had a bankruptcy? And if so, how old is the bankruptcy? Because I got a customer that told me just last week, and it's a big brouhaha right now. My wife had a bankruptcy 3 years ago. And then when we get into it, on the credit report, the bankruptcy's really only 1 year and 11 months. And so the customer's saying, no, it was 3 years ago. And I'm saying, yeah, but the discharge date is only 1 year and 11 months has transpired. So that's a trap door. And we can do loans outside of 2 years bankruptcy on an FHA loan. So it's not a problem. We just got to wait 30 days. But he's mad. And he's mad at me because he told me 3 years when in fact it's not. So just a trap door, please ask your customers. On rental property, this gets pretty crazy, because if the customer has 10 rental properties, we're going to need a copy of the lease agreement, a copy of the tax bill, a copy of the fire insurance policy, the homeowner's policy. We're going to need a loan statement. And if it does have an HOA invoice or bill, we're going to need a copy of that. So that's 1, 2, 3, 4. Let's just go with 4 and 10 properties. That's 40 documents just for rental properties. So I would be conscientious of understanding what his real estate portfolio looks like, so you can help prep him. And then we're going to clean it up with business licenses, CPA letters, P&L statements, balance sheets, all of that, if the borrower is self-employed and it requires it. And here's kind of a fun side note. If the customer has co-signed for his son or his daughter for a car or any other debt, if we can show the son or the daughter has been paying 12 full months of payments, we can remove that debt off the customer's liability screen. We can omit it. So even though they've co-signed, that doesn't mean that it's going to be counted as debt towards them. Okay, so that's just food for thought to keep in the back of your mind. These are like cool cliff notes that you're going to run across sooner or later. And so it's good to know what you can get around, what you can work with. Okay, so if there's any questions, maybe you can chat with Shirley and she can chat with me. I'm not sure. If not, you can always text me. That phone number again was 949-677-1001. All right. Moving along, see how we're doing great on time. Okay, so moving along, the loan process. Now, the reason I want to teach you guys the loan process, all realtors, the loan process, is because it's a series of milestones. And all you care about is the loan that funds. I get that. Everybody gets that. But it's got to go through these processes, and you can't leapfrog a milestone. You can't leapfrog a stage. Think of a loan very much like an automobile manufacturing plant, say the Ford manufacturing plant back in Detroit. So at the beginning of the line, the manufacturing line, in our world, it's the loan application. In their world, it might be the frame. And then the frame goes to the next stage, which might be the wheels. And then it might go to the next stage, which would be, say, the seats. And then it might go to the next stage and it might be the engine. And it's going to follow that path all the way till it comes out a fully operational car. It's identical with the loan process, okay? So the first step is the application, and that comes back to me, and I can structure the loan. As soon as I know what we're doing, then the loan gets sent to processing, and the processor is going to do all the checks and balances. They're going to run credit, we'll match liabilities, we'll review the liabilities to see what we can omit. For example, you know, the car loan that is being co-signed by the son or the daughter, and that could be omitted. Sometimes there's duplicates. They're going to do checks and balances. They're going to run MERS. There's a whole laundry list of what the processing department does, and they prepare the file for the underwriter. So now I've had it for a day or two. I send it to the processor. She's had it, or he's had it, for a day or two. Then we've got to collect all the documents before it can be sent to the underwriter. So if all the documents are in, but the customer refuses to send us his ID, I can't send the file in. So we want to get everything up front, tight. And if you do it right the first time, the transaction runs so much smoother. If you piecemeal it together as time goes on, people lose focus on it and you forget things. And that's what causes delays. So we're real sticklers about doing this right. We're going to get all the documentation up front. I'm not an underwriter, but I understand it well enough that I would know how quickly or what the problems of the file are. And when I understand the problems of the file or the nuances of the file, then I can write letters of explanation to work around those items. Once it's in underwriting, the underwriter is going to verify everything that we've had to say. And the underwriter takes, 2 or 3 days to get back to us, or 1 day, depending on the line. Remember, a loan can be done in about 10 days, but you're going to have to leapfrog 300 files ahead of you to get that loan done in 10 days. And do we leapfrog loans to get a loan done in 10 days? The answer is yes. We can do that on a case-by-case basis, but it's not normal practice. Normally, we have a 30-day escrow, and so we judge the process to use that 30 days while we manage the other 299 files that are in the pipeline, if that makes sense to you. And hopefully it does, because if I had everybody's undivided attention, I could close a loan in 5 days. And I actually have taken an application on a Sunday night and closed it that Friday. That was a while back before the 3-day disclosures on the TRID laws kicked in, but we leapfrogged everybody and it got done. So it can get done. It just has to be a really unique situation. Okay, so once it comes out of underwriting, your loan is going to be approved with conditions. So when I say, congratulations, you have conditional loan approval, I want you to hear the word conditional. Okay. I didn't say your loan was clear to close. What we say is it's a conditional loan approval based on these conditions. The conditions are items that need to be satisfied before you can get to clear to close. Now, 9 out of 10, well, 9.9 times out of 10, once we get a conditional loan approval and we read the conditions, we know that we can meet those conditions. And so a condition could be as simple as the missing page 7 of the June's bank statement for Bank of America ending in 5001. It could be that simple. Or it could be more complex. You sent in the first quarter of your profit and loss statement when in fact we're in August, therefore your second quarter would be the most current one. So you need to send us your second quarter of your P&L. It could be a million different things. It could be an ID issue. It could be items on rental properties. Whatever the condition is, we have to satisfy it before you can get final loan approval. Okay, so, but conditional loan approval is great because, like I said, 9 out of 9.99 times, we are going to ultimately close that loan. But I don't want you to think that deal's done because it's not. All right. Then once we get those conditions, we have to meet those conditions. So we will go back to the customer and we will get all of the missing conditions or correct the conditions that need to be corrected. We write a lot of letters of explanation to explain items away. Very acceptable process. Everything just needs to make sense to the underwriter. And at that point in time, we're going to get what's called issued a clear to close. And by the way, meeting those conditions, this is tricky. This is where if the customer sends us a fresh bank statement and that bank statement has 3 new large deposits, it now triggers us to ask for sourcing or proof of those 3 large deposits. So what happens is the customer now gets frustrated because they sent us the updated bank statement, but things have changed. And so it triggers us asking for new documentation. So then they get upset because, like, why do I have to do that? And I said, well, because we can explain why, but I'm just letting you know that this is what delays loans. Is that when we open up the conditions, sometimes they trigger more conditions. And there's nothing we can do about that because Fannie Mae and Freddie Mac's guidelines are 1,200 pages long and we have to follow their guidelines. So we work very empathetically with the customer to let them know this is why it got triggered. And then we work through all those conditions. But that can be a tense time and that can be a very time-consuming time because sometimes customers just want to blow it off and they won't respond. And we can't do anything. So I'm going to get you involved to hammer your customer to respond to us. And we can only work as fast as the customer, okay? We're not 9 out of 10 times, we're not holding the show up. There are times when we get swamped and we do hold the show up, I will admit. But 9 out of 10 times, that's not the case. It's usually the customer that holds the show up. Okay, so once all those conditions are met, and then if any conditions were triggered to be met, that period now lapses. We've got them all satisfied and approved. Then we get what's called the clear to close. So as a realtor, here's the cliff note. Ask your loan officer, where are we at in the loan process? How much further do we have to clear to close? Or do we have clear to close? Or if you want to be sharp about it, say, hey, when do you expect CTC? That is an intelligent realtor question to ask a loan officer, any loan officer. How far off are we to CTC? Because that's the magic number or the magic words. You want to know CTC, clear to close, because at that point, then the escrow officer and the loan funder have to balance the closing disclosure, which is really the loan estimate. And so they're going to balance out all of the escrow fees, all of the title fees, all of the bank fees, the appraisal, the wiring. All those fees now get balanced to the penny today. And so that's a process that takes 24 hours. And once that's balanced, then we can order the loan documents. Now, remember, loan documents, so escrow and funder, if they miss each other for 2 days, that's a 2-day delay. And there's nothing I can do to bridge the gap if we can't get a hold of the escrow officer. We can hammer on them, but that's where we're going to probably pull you in and say, look, you got to call your escrow officer. The escrow officer's got to call the funder. It's got to be done in an hour, and we need to get this thing balanced so we can get to loan docs. So that's an area of at least 24 hours. A lot of times 48 hours. Then we order loan documents. Loan documents, depending on the doc draw person, could be kicked out in 1 hour. It could be cooked out in 1 day, meaning the following day. So we don't know what the volume is on any given day. So we can ask and we can find out for you. And if we're pressed for time, and we know we're pressed for time, we just go to management and say, hey, leapfrog this file to the front of the line because we got to get docs out in the next couple of hours. Cool. Any questions? Shoot a text as we go, and I'll keep an eyeball out for it. Then the next step is, once the loan documents are ordered, they're going to get delivered to the escrow officer. Now, the escrow officer has to package those docs. More time. If the escrow officer is swamped, she may not, or he may not package them. They may not package them for 24 to 48 hours. So there can be a delay there. We try to get them done right away, but and they only package in the afternoon, by the way, because they're doing all their fundings in the morning. So if they've got 5 to package, there's a good chance they're not going to get packaged that day if you're not one of those 5. Because it takes time for them to package them. Once it's packaged and they're ready, the escrow officer is ready to go, they're going to assign a notary. The notary will then receive the loan documents from escrow and set up an appointment directly with the customer. The notary can meet the customer at a coffee shop, at their place of office, at a library, at their home. They can meet at the apartment. They can meet anywhere they want to meet to sign loan documents. Today, there's 2 sets of loan documents that are going to be signed. There's an electronic set that will be emailed to them. This is our new movement into e-signing loan documents. So the loan package itself is about 168 pages. 120 of them or so are now falling in this e-sign. So the customer and his spouse, if there is one, they can go online. They can sign all their documents separately, and they're merged together. And that would be all of the, what I would call non-critical loan documents. And then the critical loan documents are the ones that are going to require a wet signature. And so the notary now shoots out to meet with the customer to get the wet signatures, to look at their ID, to verify ID, to notarize the documents, get them signed in the book. And that set of documents has been cut way down. So notary time has been cut way down. So they can get in and out quicker, and it just makes it a lot easier for your customers at the end of the day. Once the loan docs are finished, they will go back to the escrow officer, and the escrow officer has to check them in. They don't check them in the moment they arrive on the desk. They check them in order of their day. So loan documents may not get checked in till late that afternoon. And at that point, it could jeopardize funding. And a lot of times it does jeopardize funding. So you don't fund the day you think you're going to fund. And that's, again, just it's timing. And these escrow officers are under a ton amount of pressure. And I really, they have a hard job. But once the loan officer, or I'm sorry, once the docs are checked in, then and the escrow officer is ready to go, they contact the funder, which is the bank's funder, New American Funding, and the funder then would release funds. And once funds are released back to escrow, escrow pays off everybody that needs to be paid off, and then the transaction's considered done, but technically it's not. Here's another nuance. Even though the loan's been funded and everyone's been paid off, it still needs to be recorded at the county recorder's office. Now, 9 out of 10 times this is done same day and it's done easily. On occasion, it'll drift into the following day. Not a problem. But I've had an experience where First American got their computers hacked and they could not record a transaction for us for over 2 weeks, which is really an awkward position because the customer technically doesn't own the home. He does own it because everybody's been paid off, but it's not on title at the county recorder's office. So until it gets inked at the recorder's office, that's when you're final done. Cool. So that's the loan process. So it's a little probably more complex than you realized. It's simple for us because we do it every day. We prep our customers ahead of time. This is what to expect. And we just walk them through every stage. And each one of these are really considered milestones as we go through the process. Cool. Any questions, comments, or concerns? Not that I can see you or hear you, but again, if you want to text, that phone number is 949-677-1001. And then my email address is jeffrey.scott@nafinc.com. NAF stands for the acronym New American Funding, Inc., inc.com. All right. So with that said, what I'd like to talk to you about and teach you so you can clearly communicate this with your customers is that there are 3 loan silos that are available to all consumers from Los Angeles to New York and everybody in between, period. There are 3. Now, if you want to count hard money as a loan silo, you could lump that in and call it 4. I don't call hard money a loan silo because it's private money and it falls outside of the banking regulations. But for all intents and purposes, it really is a 4th silo because hard money is available to all consumers in most cases. But let's talk about the 3 loan silos and why they're so important to you. And here's some of the things that I want you to keep in mind when you're talking with your potential buyers. Because when do you want to blow a deal? You want to blow a deal as fast as you can. Now, I know that sounds counterintuitive, but time is all we have. Time is money. And if you get in bed with a customer that's not telling you the truth and is disguising his motivation and is disguising his financial picture, and you spend 6 months with that customer before you find out that he had no intentions or capability of ever buying a house, you've wasted 6 months of your time. So that's why I'm saying, when do you want to blow a deal? You want to blow it as fast as possible. So the ways to blow a deal quickly is one of the first things you have to do is ask, what's your employment? Okay. So if the customer says, I'm a W-2 employee, I work for Qualcomm, I've been there for 10 years and I make 180 a year, and that is a solid buyer, probably. Okay. But if the customer says, yeah, I'm self-employed, I own 3 small businesses, one's an ice cream company, one's a internet social media company, and one's a tire changing company, you've got to ask, are they profitable entities? Because a lot of times these customers that own small businesses milk all the cash out of it, so there's no profit at the end of the day. So the tax returns show no money. Now, I'm not saying there's not other ways to get a loan, but what I am saying is it's super important that you understand where their income comes from. Okay, right up front. So the other $1 million question to ask them is, how much cash have you set aside for this transaction? Now, if they're selling a departing residence, that's a little bit of a different story, because the departing residence should have equity that would create a big pool of cash to close. But if it's a first-time home buyer, you've got to get a pen and paper out and write it down. How much cash do you have that you're willing to part with for this transaction? And you need to get a number on paper and you need to see it. And so if the customer says, I have $50,000 in the bank to buy a house, your first question is how much of that 50,000 are you willing to part with? And he goes, well, I do, oh, the credit card's $5,000 and I do need $5,000 for moving expenses. So I can part with 40 grand. All right, great. So now you've got a number. And zero is a number, okay? If the customer says zero, that's a number, and we can actually work with zero, but we need a number and we need it up front. And you've got to get this up front because you need to understand what kind of customer you're dealing with at the end of the day. So cash to close and down payment are two different things. So the customer you've now identified has 40 grand for cash to close. And that number could be 400 grand. It doesn't matter. I'm just using a number, 40,000. You have that number is going to be broken apart into two parts. You have down payment and you have non-recurring closing costs and funding the impound account ahead of time for taxes and insurance, and prepaid expenses on the new loan, and 1 full year of fire insurance. So that's not part of your down payment over here. This is your down payment. So if the customer says it's I want to put a 3.5% down payment on an FHA loan, and that's going to total $30,000, that's kind of good because that leaves me $10,000 extra cash for non-recurring closing costs. Now, non-recurring closing costs, which is paying for all your closing costs, plus funding your impound account, plus prepaid interest on the new loan, and pro rata taxes to the county of whichever county's it at, plus 1 year of fire insurance policy that's got to be paid up front in cash. That number, generally speaking, runs anywhere from $15,000 to $30,000, depending on the loan size. Okay, so just remember, down payment is not cash to close. Cash to close is the down payment plus all these other expenses to get to total cash to close. All right, so with that said, and that's real important, you get that up front so you know exactly what you're dealing with. And if the customer says zero down, I've got zero down payment, but I have got 15 grand for cash to close, we can use that number because there's a brand new FHA loan that only that does not need a down payment. It's 100% financing. So it's a product that rolled out in January. So keep that. Text me, email me about that. It's a hot product. I'm doing a lot of them, particularly for buyers anywhere between $1 million and below that are really short on cash. But generally speaking, they have two incomes in the family. They make great cash, so they can close these loans, and we are closing them. All right, so the silos, the 3 loan silos, after you've figured out how their income is generated, W-2 or self-employed, and you figure out how much cash, then we start looking at these 3 loan silos. The first loan silo is called a tax return loan silo. And that just simply means that if required, if triggered, it could require your tax returns. And in the event it does, it's mandatory you present tax returns. So I call it the tax return loans. I just got a beep. I don't know if that's you trying to reach me or what. But a tax return loan is also Fannie Mae, Freddie Mac, VA, FHA, USDA, jumbo loans. It's all the quasi-governmental loans. All right. And we have to verify the customer's ability to repay the loan. And one of the ways you verify the ability to repay the loan is through tax returns. Now, that is a law that was put into place in 2010. It's called the Dodd-Frank Wall Street Reform and Consumer Protection Act, and it's to protect the consumer to not get a loan they can't afford to repay. Okay, and that was all a result of the 2007 or late 2006 and all of 2007 mortgage market meltdown that was one of the worst financial disasters in history for the world. You can study that later, but that was a real problem. So with that said, the government also said you cannot have interest-only loans. You cannot have negative amortization loans. You cannot have any prepayment penalties in these loans. No balloon payments. The longest term is 30 years. And we're going to put some maximums on your debt to income ratio, as well as we're going to limit the bank's upfront fees and points. We're going to put a cap on it. It's 3%. We've never in a million years charged 3%. Well, there were loans that Washington Mutual did that would allow a loan officer to charge 3%, but that all ended in 2008. So it's a non-discussion at this point. So those are called, these are your better priced loans because we're requiring proof of income all the way through. When you can prove income all the way through, it reduces the risk. It's a risk-based pricing model. Therefore, these are your best priced loans. What happens though if the customer does not fit in this bucket, right? Well, here's what happens. We go to silo number 2. Silo number 2 is called no tax return loans because the government recognized that if you can't fit, and there's a ton of homeowners out there that you can't provide tax returns, but you still generate good income, you are deserving of a loan. I call these loans, you still have to show the ability to repay, but you can show it in a different fashion other than W-2s, pay stubs, and 1099s. I call these loans Wall Street loans, because they're not government sponsored. They're not quasi-government, but they're all Wall Street loans, and they're securitized in mortgage-backed securities and then sold and traded as, $50 million investments, $100 million, $300 million, whatever. So what the government has allowed Wall Street to do is to offer to the consumer, for example, if they can't show tax returns and still needed a loan, they can show 12 or 24 months of bank statements, and they're gonna the underwriter is going to look at the deposits on those bank statements as income. And then they're going to look at the type of business the customer does, and they're going to apply an expense ratio to that total income. And then they're going to come up with an income number. So you can underwrite a file today on 12 or 24 months of bank statements looking at only the deposits. Okay. They also offer a program where you have a 1099 only. And this is, perk your ears up for this. If you're a realtor, you're probably 1099 by your corporation that you work for. If you are 1099 and you're expensing off all your signs in your car and your business entertainment and your travel and your food and restaurants and all that, if you made 100 grand, you might have expenses of 50 grand. And therefore you're paying taxes on 50 grand at the end of the day. Well, that 50 grand may not qualify you for a loan. So in this bucket, you could show just your 1099 only without your tax returns and still get a loan. So they would give you credit for the full 100,000, regardless of your expenses. So that's kind of a cool thing for realtors or anybody that's a salesperson on a 1099. They'll also bend the rules and do W-2s and pay stubs without tax returns. For example, if you have a customer that works for Qualcomm, but he owns 10 rental properties, and the rental properties all throw off huge negatives, and so his tax returns are upside down, then we can just throw out the tax returns. We can qualify him on a W-2 and a pay stub and still get him a loan. This is a cool one, the asset qualifier. If the customer has $3 million in the bank, we can divide the 3 million by 10 years and give him $25,000 a month income, or whatever number he has in the bank. So that can be used as income. The DSCR loan, which is your debt coverage service ratio, what that means is if you're buying in an investment property, the appraisal will assign a rental survey, do a rental survey and assign a rent on the property. They can use that forecasted rental income as income to pay the loan. So that is qualifying your ability to repay the loan with rental income. So if you ever want to buy a rental income property and you can't qualify, that's your loan, because almost anybody can qualify, right? Because it's using the rental in the projected rental income from the house or the 4 units. And then this is just mind-numbing to me. They can use a combo of all of these to qualify a customer. So they can use bank statements and Social Security income and asset qualifier, or which is dividing, your net worth by 10 years. They can use them all together to get a number to qualify you at. They just have to do the ability to repay. And it looks like I've got a duplicate in here, so I'm sorry about that. The investor cash flow is the same as this DSCR up here. Okay, so that's silo number 2. Great silo. I do a lot of business in this area, particularly for self-employed people. And I also do it for attorneys that are high net worth attorneys that don't want the hassle of paperwork. So we just, a lot of times, or retired people that don't want that can't retire because their Social Security income isn't sufficient to generate the income they need. So the asset qualifier is a real cool product for what I would call more wealthy people. Cool. So tax return loans, silo number 1, no tax returns, silo number 2. Then what happens? And this is what makes us unique from the rest of the community out there, New American Funding. What happens if your customer doesn't fit these 2 silos? Any idea? Well, the government, in its infinite wisdom, believes that if you are a ready, willing, and able buyer, and you have 20% down payment cash ready to go, and you have a decent credit score of 660 or better, and you cannot prove your income, but you can come up with 20% down, they believe you still should have the right to financing, to buy a home. Because the government, in the big picture of controlling society, for lack of a better word, wants civil rest. And a homeowner who has got to go to work every day and make payments on his house and pay all of his bills and take care of his family, that's a pretty non-disturbing citizen in the world. It actually keeps us working, and it keeps civil rest. And so the government wants everybody that wants to own a home to be able to have the ability to buy a home. Now, this is a loan you've never heard of, and neither has 9 out of 10 loan officers out there. It's called a United States Treasury loan. So this is a government-backed, government-sponsored community development loan. It falls under the FDIC. It's for people for whatever reason do not qualify in silo number 1 or silo number 2, but still want to buy a home. In this particular loan, the government has granted a one-time, or this this community loan has granted the exception to the rule of the ability to repay. This loan does not have to prove the ability to repay. At the top of this, it says no income documentation. So I'm not saying it's a stated loan because no one is stating anything. What it is the waiver of income documentation totally. But it does have a catch. And the catch is basically 18 months of cash reserves after the down payment and the closing costs have been paid. So if we drop down here, the loan that will go to, if you have 20% down payment and a 720 credit score, which basically means a 20% down payment, and at the end of the transaction, you still have 18 months of cash reserves, the United States Treasury Community Loan will be approved for you. And we do these loans, and they're pretty trick. If you have a lower credit score of a 680, the way they protect themselves is they increase the down payment to 625, and you still need 12 months of reserves. Now, if you drop down to a 660 FICO score, which is the lowest, you've got to come in with a full 30% down, which is only 70% loan to value. And if any customer is going to put 30% down on their house, they're probably not going to default on it because that's a lot of money. So the loan knows, the United States Treasury knows that if you're probably not going to default on it and you're going to put a full 30% down, we're going to give you a break on your reserves. We're just going to cut it to 12 months reserves. So that is how that loan goes all the way up to $2 million. It's an amazing loan. I mean, and then you can do a cash out loan on the house that you currently own right now if you got caught in this silo where you couldn't get loan number 1 or loan number 2. So we love this loan. We do a lot of these loans. There's a very few lenders that offer these loans. It's a sleeper. I know it intimately. I do them. I love them. I like them. You're probably asking me, well, what's it cost? And so let's review this, okay? So if you have 3 loans of 3 silos of loans, and one is a tax return loan, that means that the bank gets to review your income based off your tax returns as well as your pay stubs and your W-2s or 1099s. That's your lowest risk loan. Therefore, this is your lowest priced loan because it's the lowest risk. If we don't meet this category and we move to silo number 2, we're still showing the ability to repay, but we're not providing all of the standard loan documents like tax returns, W-2s, 1099s, pay stubs. Therefore, this loan is more risky. Therefore, it costs more to compensate for the higher risk. Now, does it matter if the customer pays more for their financing if they don't have any income on their tax returns? Here's my point. If your tax returns are not showing income, that's meaning you're paying very little taxes. So I'm not saying you're cheating the government on what you owe them, but what I am saying is that if you are paying so little in taxes that you can afford a little higher mortgage rate over here. And the government's gonna, and that's kind of the way it's played. If you're paying in silo number 1 all of your taxes fairly, and the government sees that you're paying all your taxes, then they're going to give you a government sponsored or a quasi-governmental Fannie Mae, Freddie Mac, FHA, VA, USDA, or jumbo loan. If you're not paying or you can't provide your tax returns, then you're going to pay a premium. Is it bad? No, it's about a 1% in interest rate. I'm here to tell you who cares. Now, of course, you may have a different opinion of that, but what I'm saying is you've made that up tenfold on your tax returns. So I don't, it really falls on deaf ears for me because I know you're not, I know the tax returns aren't, I know there's so many buried expenses in those tax returns that you've been taking such strong advantage of. Just take this loan, get the house because you want to control the house at the end of the day. That's where your real money's at. Your real money is not quibbling over a 1% interest rate. Your real money is in the appreciation of $1 million house that goes up by 10% the first year, $100,000. That's where your real money's at. So if you don't fit these two buckets, then the last bucket that you're going to fit in is the silo number 3, and this is going to cost you about another percent higher. So nothing wrong with it. It works great. We do them all the time. This loan is designed for the ease of getting into it quickly and easily. You can close on the house. You can always do your taxes next year and refinance out of them. So that's that loan. All right, still no texts, and I don't see any chats. So I'd ask if there's any questions, but I don't know how you can ask them. I'm sorry. But you can always text me 949-677-1001, or you can always email me jeffrey.scott@nathinc.com, and I will be glad to answer them for you. Okay, so that's your 3 loan silos. And so when you're going back to your customer, when you're asking them, what do you do for a living? Then you can automatically start to think, well, he says I'm W-2, and oh, bam, we can stick him in an easy government quasi-government sponsored loan. Bam, easy. The guy says, oh, I'm a entrepreneur and I have 2 businesses. Then okay, bam, I've got to move him into probably the silo number 2 because his tax returns are probably not going to show enough income. But if the tax returns, and we do see big tax returns, so if the tax returns do support it, then we can obviously put them right back into silo number 1. So we do silo number 1 always. If they don't qualify, we move them to silo number 2. We've got lots of solutions and options. And then if they refuse or don't qualify or don't want the headaches of doing that, we move them to silo number 3. There's always a loan for a customer at the end of the day. Now, if you want to talk hard money, you got to come up with about 40% down payment. And it's going to be a 2 to 3 year term. And the interest rate is going to be 11.99. And you're going to pay 3 to 4 points. And the hard money loans available, and we do them. And they're situational, if you will. It's private money. So that would be your fallback to the fallback. Okay, so that's everything that I know for class number 1. It's 2 o'clock. I don't know how to answer any questions at this point. So if anybody has any questions, there's my contact information. Class number 2 will be next week. We'll be sending out the email on Monday. We're going to get into some different topics in class number 2. I love class number 2. We're going to talk about loan structure. We're going to talk about loan pricing. We're going to talk about the underwriting methods. We're going to talk about interest rate buy downs, both temporary and permanent. And then mortgage insurance is your friend. And I love mortgage insurance for so many reasons. So I will teach you why mortgage insurance is one of the coolest products on the face of the earth. And I love it, love it, love it. And it works every time. So my name is Jeffrey Scott. Nice meeting you. I'm going to sign off now, and I hope to hear from you soon. Thanks so much. Bye-bye.